I'm Jennifer Howell, and today I'm talking with Rick Van Ness. His new book, Why Bother with Bonds, is about how to build an all-weather investment portfolio and why it should include CDs, bonds, or bond funds. The target audience is ordinary investors, usually beginners just like me. Rick, thanks so much for joining me.
Thanks for having me.
This past week, the stock market has set new record level highs. What's an all-weather portfolio, and why should bonds be part of that?
Our problem is that we never know what will happen in the future. As an investor, your risk is not having the amount of money you need when you need it. Most of us are not going to achieve our financial goals by saving money and stuffing it under our mattresses. We need to rely on the growth of stocks over long time periods to achieve those big long-term goals. But it is bonds that controls risk. Otherwise, we would put all of our money into the stock market, which has higher expected returns, but also very high volatility.
The title of your book's provocative. Why bother with bonds? Is it actually about why we need to include bonds? Or is it about why bother?
Yes, my book highlights 4 reasons. Stocks are risky, bonds make that risk more palatable. Bonds can be a safe bet, and bonds are an attractive diversifier. But we could simplify that down even further and say it's all about risk, controlling risk. For instance, if you will soon need your money for a house down payment, you pretty intuitively know you better not put that money into the stock market, which could drop 50% in a year.
Okay, so I should invest in bonds. So where should I start?
I like to say that there's 2 things that are important. Your most important habit is to save a portion of every paycheck. The second thing, it's this asset allocation. How much to put in stocks and how much to put in bonds. This is where you control the risk in your portfolio.
Interest rates have been low for a really long time. Does that make investors reluctant to invest in bonds?
Well, 2 things to know are that people cannot predict future interest rates any better than they can predict stock market, which they cannot. And second, that an increase in interest rate isn't necessarily a bad thing for bondholders. You're highlighting the problem called market timing. Investors like you describe want to be in the investment du jour, the investment that is currently outperforming the others. This week, they are probably wishing they were 100% stocks with no bonds. But these investors often overestimate their predictive skills and risk tolerance. They buy when stocks are hot, they flee to the safety of bonds after stocks tumble. And they don't do as well as they could with a simple common sense strategy.
I know that when interest rates go up, bond prices go down. But why is it that bonds seem so much more confusing than stocks? People get all tripped up by how they are affected by interest rates. I'm really glad you decided to include so many examples about that in your book.
Yes, and that's ironic because bonds are much simpler than stocks. It's the goal of my book to help you see this. Stocks can change in a day what bonds might change in a year. There's 1,000 things that affect the price of stocks. Bonds are very simple. You loan your money. The bond is a promise to return your money on a particular date. And meanwhile, they pay you an interest rate for the use of your money. So a bond is like a simple loan.
So if you believe interest rates will go up, would it be smart to wait?
Let me ask you, with that CD, you are going to get that $1,000 back in a year with all the interest payments. In fact, you're going to get exactly what you signed up for today with no surprises, not one. Suppose you know that you'll need that money in a year. Where would be the appropriate place to invest it? In a CD, which is in a special form of a bond, or in the stock market?
Okay, that's the idea of matching when I need the cash with when my bond matures. But how does it work with a bond fund without a maturity date?
It sounds like you get it. Now, a bond fund is just a collection of individual bonds, but it is far more convenient for most people. Now, here's the part I want you to remember. You can have a fund of short-term bonds or long-term bonds. Either way, if you hold the fund for longer than its duration after interest rates increase, then you'll come out ahead because the bond fund is constantly reinvesting at the new higher interest rates.
Yes, this was in your book and the diagrams were really helpful. You also made the point of investing only in U.S. Treasuries and very high quality bonds.
Yes, the argument is that it's better to control your risk with the correct amount of bonds, U.S. Treasuries, and to keep your risk in the stock market. The simple explanation is that junk bonds are more correlated with the stock market, so those bonds can go south at exactly the wrong time.
For stock investments, I always hear how important it is to diversify. Is the same true for bonds?
For most people, that's just fine. They'll end up with the total bond market index fund, which is predominantly U.S. Treasury bonds. But if you understand a little more, you'll see the differences. I've bought the argument that it is smarter to stick with the very highest quality bonds, U.S. Treasuries, FDIC-insured CDs, and TIPS, which are a bond that the principal grows with inflation. I explain several reasons for this strategy in the book, but you probably appreciate that bonds backed by the U.S. government are as good as it gets, so you can't reduce credit risk any further by diversifying.
So you control risk by allocating between stocks and bonds. How do you figure out what percentage to put in bonds?
First, we are investors, not speculators, not gamblers. Let's separate the money we need for the short term, because the stock market can literally lose 50% of its value in any year. We all have many goals, but by far the biggest, for most of us, is to finance our retirement. When you're in your 20s, this can be predominantly with stocks. When you're in your 80s, this might be predominantly bonds. How you change every year is a rich area for discussion, but the percentage doesn't really matter as much as having a plan, a simple plan, and sticking to it.
Thank you. I like the examples you have of this in your book. I have one last question. You spend a lot of time volunteering, teaching people about common sense investing. Why?
I'm actually very attracted to the idea of living frugally and thereby capturing the freedom to spend your time as you choose, as you wish, to wake up every morning and either make a contribution or just savor our time on this planet. But that's the stuff for another interview.
We'll look forward to that. Meanwhile, good luck with your book.
Thank you.